US stocks are dragged down by big tech names. European rate cut bets move further towards 50 basis points in December. Canada cuts rates by 50 basis points, and Singapore's inflation is higher than expected, but provides enough for policy easing. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Chief Economist Richard Yetsenga was in China during the recent stimulus briefings and gives us his take on what the domestic economy there is facing.
It's not really a policy package that is delivering something direct to the business sector. It's more a policy package which is supporting what in the authorities' views are some of the drivers of the growth slowdown.
But first, in 5 and 5 with ANZ, US stock markets were dragged down overnight by a sell-off in tech stocks. The S&P 500 was down 0.9% at 4 a.m. Sydney-Melbourne time. Also dragging was continued lowering of bets for US Fed rate cuts in November and December. Meanwhile, the Bank of Canada cut its key rate by 50 basis points to 3.75% and signalled more cuts to come, citing progress on disinflation. Rate cut bets are also on the rise in Europe as investors look to the possibility of a 50 basis point cut in December. ANZ economist Bansi Madhavani says that while the market is debating the size of the next cut, what matters more broadly is how much rates will be cut all through the easing cycle.
For markets, there is a debate whether the ECB steps up the pace of easing, which is, does it move to 50 basis point cuts, or do they maintain their 25 basis point pace? On that, President Lagarde said that the ECB will base their decisions based on incoming data. Our view is that the ECB will not pre-commit to a defined interest rate path, and the debate over interest rate decision in December will remain open and data dependent. But broadly, we are confident that the total easing cycle will amount to 200 basis points, taking the policy rate to 2% in 2025.
The US dollar index was 0.4% up at 4 a.m. Sydney-Melbourne time as Treasury yields rose a further 2 to 3 basis points overnight. The Aussie dollar was down 0.78% at 66.29 US cents, while the Kiwi was down 0.69% at 60.00 US cents. Number 2. The gold price has been hitting new highs this week, although after a fresh high overnight, by 4 a.m. Sydney-Melbourne time this morning, it was trading down 0.9% at $2,734 an ounce. ANZ senior commodity strategist Daniel Hines says demand for gold had been rising as the Fed commenced its rate cut cycle, although that driver has weakened recently as rate cut expectations are pulled back.
The reason behind the gains has been that haven demand. Certainly the tensions in the Middle East remain very high following Israel's killing of Hamas leader. But we're also seeing political uncertainty also emerge in the US with the presidential election just around the corner. So we've seen a real shift in risk appetite for investors, and certainly gold has come to the fore as key hedge coming into this highly uncertain period.
Number 3. Singapore's headline inflation came in hotter than expected at 2% year on year, with core inflation at 2.8%, also beating the market forecast. ANZ Chief Economist for India and Southeast Asia, Sanjay Mathur, says the Monetary Authority of Singapore's commentary after the release indicates it still should be able to ease policy in early 2025.
They reiterated that the balance of risk or the risk to inflation are fairly balanced at this point in time. And that's a departure from what you would hear, say, last year when the risks were tilted to the upside. The second is that they've also pointed out to other measures of inflation, such as unit labor costs, which is really wages adjusted for productivity growth. And they do believe that the increase in unit labor costs will be more moderate going forward.
Number 4. South Korea releases September quarter GDP data today. ANZ Asia economist Crystal Tan is expecting a modest 0.3% quarterly expansion and 1.8% growth for the year. She says the recent Bank of Korea rate cut will help growth from this level at the margin, but that more easing is required.
Exports have remained robust, and that's thanks in large part to the semiconductor sector. However, if we focus on just domestic demand indicators, those have been quite sluggish, including retail sales and also construction stats. The thing is, South Korea's economy is highly leveraged, so tight monetary policy settings over the past year or so have taken its toll on domestic demand, including through higher debt servicing burdens.
Number 5. Malaysia's headline inflation is expected to tick up to 2% in September from 1.9% in August. ANZ economist Arindam Chakraborty says the rise is set to be led by transport, recreation, health and education prices.
Inflation is actually expected to remain broadly stable in the coming coming months. In its 2025 federal budget, the government has also mentioned that the RON 95 subsidy rationalization is likely to be carried out by mid-2025. Therefore, considering the stable inflation and growth outlook, we think the BNM will keep the policy rate unchanged at 3% in 2024.
Aaron Chakraborty there. Now, on part one of a bonus deep dive interview with ANZ Chief Economist Richard Yetsenga, Richard has just returned from a visit to China. He takes us through the economic situation there.
There's no replacement, even in the modern world, for just visiting somewhere and spending some time getting the pulse. This is the 20th year I've been going to China. My first visit was in 2004. I've been at least once a year since then, sometimes 2 or 3 times a year. So I suppose over 30 times. And every time I learned some new things. This time, maybe the most impactful piece of information was what a different share of the conversation the recent stimulus packages are onshore versus offshore. Offshore, of course, it's the latest news on China, a lot of analysis and thought going into what it actually means and what the target actually is and what might have driven the shift in view. Onshore, from the business community, it's much less a topic of discussion. I suppose taking a wait and see approach. It may also be that more kind of sanguine, less emotive, less focused kind of thought process on the policy packages reflects the fact it's not really a policy package that is delivering something direct to the business sector. It's more a policy package which is supporting what in the authorities' views are some of the drivers of the growth slowdown, local government debt, issues in the stock market, issues with the property sector, and then hoping those flow through to the business sector.
Is there more confidence building in terms of the general population?
Confidence, definitely a word that is used, not necessarily in the context of the stock market. And certainly for me, I struggle a bit to understand what they would like the stock market to do. On the one hand, there have been restrictions on short selling activity, on the ability of funds to sell, to try and limit maybe the confidence signal from a stock market that is too weak. But on the other hand, when you restrict those activities, you're unlikely to get a big bounce from policy efforts and stimulus efforts, because part of that dynamic is the market is positioned the wrong way and you get a slingshot out. Equally, a lot of people onshore seem quite confident in opining that the authorities don't want the stock market to run away on the top side either. Personally, I wonder whether they should spend less time worrying about what the stock market might or should be doing and get the fundamentals right, and the market will do what the market does. Where confidence is used a lot is in the context of stagnant consumption. The common policy prescription or policy diagnosis for consumption seems to be it's a confidence issue. We need to build confidence in the consumers to get them out of their funk, if you like. I'm less, not to overuse the word, I'm less confident that focus on confidence is the right strategy. There are less consumers. The population is falling. That must be a bigger headwind. The housing sector is about 60 to 70% of household wealth. House prices are falling. That must be having a big impact. I suspect it's more fundamental than just confidence.
So take us through that domestic consumption picture, because we do hear about this sort of two-speed economy where external sectors are still doing okay, but the real drag is on domestic consumption. What do you think is required to really spark that?
Well, investment is still growing faster than GDP, so the consumption share in trend terms is still falling, and the maths is pretty simple. If you would like the economy to grow at 5% in real terms over time, incidentally, I think 5% is probably going to end up being too high a target, but if you want to aim for 5% and do that in a more sustainable fashion, I think everyone agrees you need to raise the consumption share. Consumption has to grow more than 5% in real terms, and with a shrinking population, per capita consumption obviously has to grow even faster than that. It's difficult for me to see that happening when the household sector's biggest asset is declining in price, when the household sector's debt to income ratio is higher than the US, and when the labour market is pretty soft. I mean, the labour market for graduates particularly is very soft. If there is a confidence challenge, I think there are some fundamental causes rather than it being driven by something which is, in some way irrational.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, October the 24th. Catch you tomorrow with more from Richard on how China's authorities will take lessons from the current situation, and also some insights from a recent trip to another growing powerhouse, India. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.